Hello and welcome to the Investing Edge, where each week we try and distill the learnings from the wealth management industry for our viewers. I'm Sumaira Abidi, and with me is Feroze Azeez, Deputy CEO of AnandRathi Financial Services. Feroze, thanks very much for joining in. You know, over the last few days and weeks, we've seen the market take off. A lot of the portfolios which were negative for the year have turned positive. Investors are looking happy. You think the good run is going to continue?
To my mind, yes. Likely to continue with some caveats, of course. Whenever you see negative or positive, you need to see the time frame. If your portfolios could actually be negative for 3 years, then it's a very, very exceptional situation. So point one, of course, there is so much stimulus going to be given by the government, because like we have spoken in the previous shows before some of these announcements, that whenever the economy does badly and your portfolio does badly, don't worry. Because if your portfolio is nobody's concern, but the economy certainly is. Every time in the past, when only markets have done bad, the economy is doing okay, no government will intervene, because nobody wants to manage capital markets. Everybody wants to manage economy. So if that's the case, you will see several other measures given to make sure that the unemployment reduces. The companies which are actually the top 50 companies, for example, in India, need to have a better growth in their profits. That's when the economy will be better, because then they will spend more, they will put more plant and machinery, they will create more employment. So since economy is not doing too well and capital markets are not done so well so far, so it always makes me believe that there will be enough stimulus given for this to be. So economic management styles change in these kind of situations, and we have seen that in the past, that the problem which you are in today, from an economic slowdown perspective, the stimulus creates a quick fix, at least, if not a complete treatment of the problem.
Okay, so, speaking of capital markets, the market has seen quite a few problems or accidents or whatever you want to call it over the last 1 year. But now it looks, or at least appears, that a lot of it is abating. Island FS, there are things coming together for that. Z is, at least halfway sorted. DHFL, which was another company that is in trouble, there as well, it looks like the resolution is not too far away. So these were some of the bigger problems. We've also seen recently the issue with Pmc Bank, right, where the Reserve Bank has put restrictions on it earlier. And this is not just the case, right? We've seen Kapol before that. Do you think mutual funds have been unduly vilified, therefore? Because, problems like these are not unique to an AMC, right?
So this kind of risk, where I lend my money to somebody, a company ko maine paise diye, I gave my money to a company and the company doesn't repay it back to me, that event is called a credit risk. Credit risk has happened in several large companies. And since they were large companies, the problem was even bigger. If they were small, tinier companies, then it wouldn't have been as big. So when AAA rated companies go bankrupt, that's when catastrophe hits you. And it hits you hard. Because AAA rated companies have a lot of interlinkage between each other as well. So that has happened. Now, from September 3rd last year, which is when this whole carnage began, there is a lot of distance traversed. Point two, of course, you have to expect some accidents. It cannot be that economic slowdown, sector slowdown, real estate इतनी तबाही मचा चुका है, but किसी को साथ नहीं लेके डूबेगा. अगर ये मेरी उम्मीद है, if that's the expectation I'm trying to create, that if real estate goes through 5 years of no price rise, it will not have a spillover effect on the sectors which are lending to it, might not be a fair expectation. Right? So point I'm trying to make is, you will see some accidents happening. Economic slowdowns will always result in such events happening intermittently for you to almost believe that everything is the end of the story. No, that's the cleaning process of a collateral damage you will see. Third is mutual funds, especially debt. I as an investor, if I speak as an investor now, I have equity to take risk. ब्याज पे मैं पैसे इसलिए लगाता हूं ताकि सेफ्टी बनी रहे. Right? So my expectation from that portion is to not give me surprises. But if that portion starts throwing surprises at me, then it shakes the principle, fundamental principle of my mental demarcation of risk and no risk. And suddenly I start seeing that risk at both sides. It's something which you can't come to terms with. So you have to manage your debt risks very well. To manage debt risk, you have to manage three risks. Okay, one is credit risk, one is interest rate risk. Okay, the third risk we can just skip for the moment. Credit risk is the biggest risk known to mankind. Why? Because in market risk हमें डराता ज़्यादा, but credit risk डराता नहीं है, but उससे खराब risk कोई नहीं. Why? Market अगर खराब होती है, 20% आपके पैसे खा जाते हैं. अगर आपने कुछ ना किया, and if you had steel nerves to hold on to it, 6 महीने में, साल भर में, 2 साल में, 3 साल में लौटा के चली जाती. Reversible.
So, whenever you lend, make sure that a mutual fund, you've bought a basket of mutual funds, understand whom are they lending to, how many companies has your money gone to finally. You might have bought 5 funds. Fund के अंदर बहुत सारी चीजें हैं, तो कितनी कंपनियों को मेरा पैसा in effect lend हुआ, ये जानना आपका फर्ज है, right? So it's important for us to question. So that's my learning. So you will keep having these accidents. Mutual funds have done a reasonably good job, especially on one thing which you mentioned, Z. They didn't come into several pressures. They made sure that they held the regulatory pressure to protect the interest of the investor and got back some portion of the money.
Okay, you know, interesting that you mentioned this. So for those who may not know, Z Entertainment is the stock which was pledged by the promoter. They had a lot of, subsidiaries, a lot of infra assets. So to sort of get funding for that, they had kept their Z Entertainment shares as collateral. It so happened that, liquidity became tight sometime towards the end of last year. They couldn't manage to repay their lenders. But the lenders decided that, the promoters were good and they wanted to help them tide over it so that there was no loss of money for either the promoter or for the lenders, which in this case were the mutual funds. Now, over the course of this year, a lot of things have happened, but as of now, how things stand, like Feroze mentioned, is that some of the mutual fund houses or the AMCs sold it at market value because the promoter had promised that by the 30th of September, I'm going to pay you back the money one way or the other. He paid back 50% of the money sometime earlier last month. He couldn't pay, he wanted an extension for the balance. Some AMCs, sold at market rates. A few of them, 4 of them, have decided to give him that extension. Now, Feroze, when investors hear that their AMC has A, either sold, or B, has decided to further give an extension, now here there is a problem because, see, in an open-ended fund, it is not a very big problem, right? But if you have a FMP product which has a fixed maturity, you want your money back at a certain point. And this is where the case blew up as well, right? Earlier this year was because of the FMPs. How does an investor read these kind of decisions by the AMC?
Point 1, you also mentioned FMPs. Okay, let me start there because that's investors' interest and that's one takeaway you can have. Never give away your liquidity unless somebody promises you 3-4% extra. Ever. Illiquidity is like bondage. You've tied yourself. Why would I tie myself unless somebody is remunerating me enough? Right? If you're taking an employment contract, if 2 employers are giving you the same salary, and one guy is saying contract sign kar 5 saal ka, तो आप बोलेंगे भाई extra salary तो दे, मैं contract sign करने के लिए तैयार हूँ. Right? You should never give away your right to take a U-turn unless you get adequate remuneration for that right to be given away. Second is, how should one read into mutual funds actions? I think which one is right, only time will say. But one thing which is certainly desirable, I as an investor, not as an advisor, would want the mutual fund industry to be consistent. Right? Mutual fund as a financial services industry has the strongest association in the form of All India Mutual Fund Association of India, AMFI, जिसको कहते हैं. अगर आपने इतनी बड़ी एसोसिएशन बनाई है तो एटलीस्ट कंसिस्टेंटली सब मेंबर्स तो फॉलो करें.
Given this environment, it becomes even more important to choose an advisor. Now, the big problem that happens with a lot of people is that they have more than one advisor. How do you narrow it down? What are the qualities to look for in an advisor who will in turn look for optimum performance from your portfolio?
I think it's very important in any service you procure, right? If you hire a lawyer, you would see how many cases he won, right? If there's a very important case, you have to win. Anytime you procure services, you need to be clear what I'm looking for, and that helps you narrow down, at least over a period. I might interview 3 lawyers, but I'll come to one over a period of time. Maybe if I had 3 cases, if I was so unlucky, then I would give each of them one, and then I'll understand them, and over a period of them, narrow on one whom I would call as my advisor. So I personally think clients don't actually ask the right questions. Do you ask the question of what's your return, what's the risk you took? So first thing is capability is measurable. Have you asked the question to your advisor, however big or small he is, what is the average return? What is the numerical risk taken by all his or her clients average? That's the first important criteria. That's the prime thing of my client's requirement. So we audited it. And we got it audited by one of the big 4 saying that I might manage less. I might not be the largest wealth management outfit. How does it matter? But as long as my client's returns and risk. So return I audited, it came to about 13.6% last 5 years. Risk we audited 9.25. How do you measure this risk? What is this 9.25 is a longer story, but Nifty's risk is 13. So if I have taken 9 and Nifty delivered 6-7%, and if my client's portfolio delivered 13.6, that is capability, okay. Second thing you should be looking for, kya he buys the same thing for his dad or his friend or his CEO as he buys for you, right? So that's the second element. Third is you have to ask this question, how many clients do you have? If he has 70 customers, then he will never be committed to you, right? Private banking mein phir private kya reh gaya? So we said that every private banker should manage 30-40 odd customers. So AnandRathi's average private banker manages 27 customers. Then you have to put some money on the table. So we hired 324 people who support 242 private bankers. So like I manage 8 customers. So I have 3 people who support me. One guy is from IIM Bangalore, the brightest guys. They will be brighter than me. So I will do the talking, right? But they are sitting there recording it and doing the analytics. So if you have to make sure the commitment to each client is high, you can't just expect commitment to be high. You have to have fewer customers with very, very strong, intelligent support.
Well, on that note, we'll take a very quick break. Up next, we'll open up the floor to questions from the audience. Do stay tuned to The Investing Edge. Welcome back. You're watching The Investing Edge. We're in Mumbai this week and we have a house full. So it's time now to open up the floor to questions from the audience. Yes, sir.
If you look at any of the Financial Times, Economy or anyone, there is a lot of scrutiny on Big Four. And from that perspective, how does it really help in terms of the advice that they give, especially in testing times when Big Four themselves are under scrutiny?
See, we have to be clear in our mind, are we taking advice from the Big Four or we are getting millions of transactions audited by the Big Four, right? Now, a Big Four could be hand in glove. That's the claim, right? So one of them actually, when he was buying a structured product, he wanted to see whether, yeah, how do I want to do an audit myself. So I said, you appoint an auditor. I'll pay the auditor fee. How much is it going to take? 5 lakh, 10 lakh? Doesn't matter. So Big Four, why? Because the chance of being hand to gloves is lower, right? If some client wants to appoint an auditor, I'm more than happy, right? Sometimes I chip in and pay the fee also. That I've done for a couple of large clients for sure. So you're not taking advice from people. You're trying to say, see, if I said 13.6, what is the choice? Where does this group have? Either accept it or not accept it. Is it a choice which a person has to check billion transactions in those thousands of crores to come to this conclusion? Second is, it is not just 13.6 output. Each constituent, right, if my strategy, I generally make clients follow the least risk possible according to me for generating 15%, make people follow the same portfolio with so low risk that most of us can follow the same portfolio. If I kept high risk, some people will be able to follow, some people won't be able to follow. So that portfolio has 4 constituents. So this 13.6 is an amalgamation or is an aggregation of these 4 constituents. So each of them have a separate return. So if something is very stark, then you can only audit a component rather than going through millions of other transactions which are wasteful. The answer to that question is, see, one is, of course, there will be hiccups, right? Today, if you have a cooperative bank going down, there will be allegations on mutual funds, there will be allegations on rating agencies, there will be allegations on auditors. That will be there. Now, I have to start somewhere saying that I believe the top 4. If you don't believe the top 4, then have an own auditor, pay a fee or get somebody else to pay the fee. But the point I'm making is, now wealth management, all of them should have this number, right? That is not even begun. Does the top 10 wealth management outfits have this number? Right or wrong is a separate story. Who audited is the third step. Does the industry have this number to have a relative comparison? The answer is no, right? The question of whether it is correct comes only when you start measuring it. So I don't know. I've asked this question to my friends in the industry. Why don't you get it audited? Why are you just wanting to say how much you manage? What is the return? That's the only reason why the client is associated with you. If you give him in writing that I will make you no return, he's gone away. He might love you for 6 months, but he's going to then end up saying that don't. So that's my answer. So you can appoint an auditor to check that.
But there is a senior citizen.
Yeah, thank you for a very engaging talk. My question is that in India, we have seen interest rates in the past 10%, 11%, 12%. Now probably they are at 7, 8% and even lower. Whereas in the Western world, it is 2%, 3%. Is it likely that interest rates in India would go down to those levels in the years to come? And in such a situation, what should a senior citizen do who is not wanting his capital to be eroded, and may not want to take the risk of equities and all that, and want to go more into debt and maybe FDs, etc. So if he's going to get a reducing interest, then how does one manage?
So of course, globe has negative interest rate also. Like some European countries have negative interest rate for 20, 30 years. आप उनकी गवर्नमेंट को पैसा दो और वो 30 साल बाद जितने पैसे दिए थे उससे कम देंगे. So पैसे स्टोर करने के कॉस्ट लेती है गवर्नमेंट. So will our economy get there? May never, because we come from an old school of thought to not print money. When you're printing some money, there's so much halla gulla, right? So globally there's so much money being printed that there are negative interest rates as well. So not just you, not just any senior citizen or whoever is wanting to retire, it's actually a matter of concern. A lower interest rate has an opportunity, has a concern as well. How do you traverse that situation? When you don't want to have equity in your portfolio, you don't want equity in your portfolio. Because debt ka byaj kam ho gaya, equity mein jao to wahan mat ho jati hai. Then you have your retirement savings, which you don't want to take chances with. Or either way, there are some young people who have a lot of money, but they don't want to take that risk. So that's where leaps come into picture. Usage of leaps become a very, very important integral part wherever you want to bring risk lower. Whatever be the reason, low risk always has to be using leaps to protect yourself. So you can use leaps to bring down your risk. Second thing is, you should always have a risk target. If you want low risk, then it's even more the reason for risk to be measured. So I would urge you, if risk is important to you, the first question is, what is your numerical measure of your current portfolio? आपके आज का portfolio जो भी है, उसका आपको standard deviation पता है कि नहीं? अगर नहीं पता हो, तो आप risk को आप उसको इज्जत दे ही नहीं रहे, right? मन में दे रहे हैं, but actual में नहीं दे रहे. So what do you mean by standard deviation? Standard deviation helps you understand the swing of the return. right? So if you are wanting to take lower risks, you should put a target on your standard deviation of 4.5, okay? Whenever I recommend to clients, I recommend 15% return with 8 standard deviation, 7.5 standard deviation. What does it mean? When I speak of 15, take it with a pinch of salt. Because next 20 years, not even 1 year, will you get 15.00. You will get more, you will get less. You will never get 15 exactly. So it is important for you to understand, when I throw a variable at you as an advisor, the next obvious question which a client should ask and which nobody has ever asked me, saying that, ये कितने बड़े झूले में मुझे बिठा रहा है? 15, 7.5 means you can go to 22.5, you can go to, on the lower side, you can go to 15 minus 7.5. This is called range 1. You should compute range 2. You should at least compute range 2. Range 2 is 15 plus 7.5, 2 times. 15 plus 7.5 plus 7.5 कितना होता है? 30. 15 minus 7.5, 0. Statistically, you have a chance of losing capital or chance of going beyond this range. The chance of going beyond this range is 2%. The chance of going beyond the first range on the lower side is 16%. So standard deviation helps you understand the swing. If you currently don't know your portfolio standard deviation, you're only thinking you are respecting risk, but you're not respecting risk, you're only respecting return. So get that measured. If you gave the portfolio, that helps me measure the standard deviation and tell you where you are on your risk measure if it is important. So if I was retired and I want to use up my money, I will still use equity. Because if interest rates are 2%, be rest assured equity is going to give you a killing return. Because अगर 2% में कंपनियों को पैसा मिलता है, तो बड़ी-बड़ी कंपनियां पैसा उधार लेंगी, मशीन लगाएंगी, तो उनकी growth और बढ़ेगी. Right? So lower interest rates are conducive for equity growth. So if I can get into equity, protecting my backside from a perspective of risk, then you will not be with 2-3%. You will make those 10-15% and pay a small cost to be in the game rather than be out of the game. So every time when there is 30% return last year, you should always use leap, right? So if you respect risk, please measure it. Standard deviation is a very, very good measure. So that's what I would say. If risk is important, you should do. And you should, in the strategy presentation, you should tell my people that calculate my risk. PMSs have 22, standard deviation 20, mutual funds have 14, structure products have 5, debt funds have 2. I'm just giving you a sense of what standard deviation each product categories have.
Well, thanks very much for that, Feroze. Thanks to you as well for joining in. With that, we'll wrap up on this week's edition of The Investing Edge. Do stay tuned to CNBC TV18.